Hey everyone, what if I told you there's one simple number that can give you a quick health check on basically any business, from your favorite local coffee shop all the way up to a giant corporation? Well, today that's exactly what we're going to break down.
You know, when you peel back all the layers of business, it really just boils down to one single fundamental question. It's a question that every business owner, every investor, and heck, even every curious customer should probably be asking.
And that question is simply this: can the business pay what it owes in the near future? It sounds almost too simple, doesn't it? But trust me, the answer to this one question tells you almost everything you need to know about its chances of short-term survival.
So how in the world do we actually find the answer? Well, we use a specific financial tool that was designed for this exact purpose. It's called the liquidity ratio.
Okay, so what is a liquidity ratio? The textbook definition is that it measures if a company has enough short-term assets to cover its short-term debts. But let's put that in plain English. It's just a comparison of what a business owns that can be turned into cash quickly versus what it owes pretty much right now. So let's break that down a bit more. First up, you've got current assets. Think of this as all the stuff the company owns that it plans to use or sell within the next year. We're talking about the obvious things like cash just sitting in the bank, but it also includes its inventory, the stock on its shelves, and even the money that customers still owe them from things they've already bought.
And on the other side of that coin, you've got current liabilities. This is pretty much everything the company has to pay in the short term. Again, it's the simple stuff, right? It's the bills from their suppliers, the wages they owe their employees, and any loan payments that are coming up fast. This is the immediate financial pressure the business is under.
All right, theory is great and all, but let's make this real. The best way to get a handle on this is to see the numbers in action. So let's walk through a super simple example together.
First, let's look at the owns part of our equation, the assets. So our little example company here has 5,000 pounds in cash, 3,000 pounds worth of stock, and its customers still owe them 2,000 pounds. You add all that up and you get a grand total of 10,000 pounds in current assets. Now, for the other side of the balance sheet, what the company owes. These are its current liabilities. It's got 4,000 pounds in bills to suppliers and another 1,000 in wages it has to pay out. Pretty straightforward. That gives us a total of 5,000 pounds in current liabilities. So now we have our two key numbers, what it owns in the short term and what it owes. And the formula that connects them, it's beautifully simple. The current ratio is just your current assets divided by your current liabilities. That's it.
Now we just get to plug in our numbers. That's 10,000 pounds in assets divided by 5,000 pounds in liabilities, which gives us 2.
And this gives us our final ratio, 2 to 1. It's such a simple number, but its meaning is incredibly powerful. So what does it actually tell us about this company?
Well, it means this. For every single pound the business owes right now, it has 2 pounds ready and available to pay it off. That's a pretty comfortable cushion, wouldn't you say? It basically has double what it needs to cover all its immediate bills.
If that still feels a little bit abstract, let's bring it right down to a level we can all understand instantly. Forget the company for a second, and let's just think about your own wallet.
Just look at this comparison. Our company had 10,000 in assets and 5,000 in liabilities, which gave it that 2 to 1 ratio. Now imagine you have 200 pounds in your bank account and all your bills for the month add up to 100 pounds. Your personal ratio is also 2 to 1. You've got twice the cash you need to cover your expenses. See? Businesses work on the exact same principle, just with a few more zeros at the end.
So let's bring this all together. Let's zoom back out. What's the key takeaway here? Why should you actually care about this simple little number? Here's why it all matters. A ratio around 2 to 1 is generally seen as a really good sign of financial health. It shows the business has a comfortable buffer, a safety net to cover its debts. It really is a powerful, quick snapshot of a company's stability. It's like taking its financial pulse.
And that kind of leaves us with one final thought, doesn't it? We've seen what a healthy 2 to 1 ratio looks like. But what does a ratio of 1 to 1 or even less really mean for a business? What kind of financial tightrope is that company walking, day in and day out? Something to think about.